My name is Claudia Green, and this is She Did That, the podcast shining a spotlight on remarkable women who are breaking barriers and proving that greatness knows no gender. From female founders who have raised millions of pounds, the investors changing the landscape as we know it, to survivors of tragedy who have achieved the amazing, and many more. We will share the stories of these incredible women who will inspire and empower you. In order to support us and these women, please subscribe on your viewing or listening channel of choice so we can continue our mission of sharing the stories that should and need to be heard. Today, I have Frankie Smith, who is going to help demystify our biggest questions around our finances, both personal and business. She is the founder of Frankie's Club, which is empowering women to take control of their finances and professional wealth, and FSWM, her own wealth management business. I'm very, very, very excited to welcome Frankie.
Thank you for having me join you.
I'm looking forward to this one. It's one of those topics that is very important, but not everyone wants to face it.
Yeah.
They say that money doesn't make you happy, which I completely agree with, but it sure can make you sad.
Yeah. And I always say money's like an enabler and people should see it as a way to get them from A to B.
Yeah.
And that's kind of how my own relationship with money is actually, see it as a tool to help you reach your goals and objectives. When you start to change the frame of the way you think about it, it becomes a little bit more digestible because it's not the funnest of topics.
It's not fun, but it can actually make your life easier in the long run if you sort of know how to manage your own finances or increase your wealth.
Yeah.
Then it's going to make your life a lot easier. So I think it's one of those important topics that people should know about. And I think this whole topic of women understanding finances, now it's normal, everybody, I'm single, I manage my own mortgage, I have all my direct debits. It's so normal. But if you think about just like 50 years ago, or not even 50 years ago, how many women in households didn't know how to set up a direct debit and whose husbands just dealt with. Yeah. I mean, I know a lot of people who sort of, if they get divorced, for example, and they're like, oh God, how do I pay an electricity bill?
Yeah.
So there's like the basics all the way through to where do I put my money?
And I think for all of us, whether it's female, male, we see it across the board. It's, we're not taught this in school.
Which is appalling.
And there's lots of great initiatives to try and change that. But really, I think we've come from decades of the financial services industry being very much knowledge is power, wanting to make it all super complicated that people disengage and can't, fathom how to get on top of things, when actually when you break it down and make it manageable and demystify, which is very much what I've tried to do with my business, you're making it accessible for people.
But a lot of people don't want to make it accessible because they don't want to, for example, if you have a wealth advisor, they want to be useful.
Yes.
So they don't want to arm you, not all of them. So what I like about you is that you want to arm people, women specifically, with the tools to do these things themselves rather than overcomplicating it. You need me. You're not going to be able to manage this by yourself. I mean, if everyone was to describe, if you've got a financial advisor or an accountant, if you just describe them, most people will have quite a similar description, even if they're not using the same accountant. Yeah. Mine not, though. I've got a young accountant. But
well, I always liken, and dare I say it, and I hope there's not any accountants listening that will get offended by this, but I liken accountants to historians. They look at what you did and then they report on that.
Yeah.
Over the course of the, your self-assessment or whatever they're doing.
Yeah.
And what you want to do is start to be more proactive and look at ways that you can help people to start to create a plan, strategy, build. And I also think, like, coming back to something you just said around wealth management or wealth advisor, that can be quite off-putting for people as well, because you feel like you have to have wealth to start. And I think something that I really want to get across today is actually it's not that. There's different ways that you can get involved. It's just about making your money work as hard as you do to earn it. That's my motto. And I think that one of the key areas I want to shake up the financial services industry is actually, I don't think it's enough anymore to just give financial advice, just do tax planning or accountancy. What I'm trying to do is empower my clients, connect them with other people, help them grow beyond just their finances. And hopefully, that means that you're doing the right thing by people and they'll keep coming back and referring you and helping you to build your business.
Yeah, I think so. Before we delve into tips and tangible advice that we can give people, I'm actually really interested in sharing your story as well. So let's rewind. Tell me a bit about you and what you studied at university. Just a little snapshot of Frankie.
Yeah. So I grew up in a really family orientated environment in Hampshire, in the countryside, very close to my family. Went to Exeter University, did a geography degree. Hadn't done maths since GCSE and was very much not interested in or not that interested in finance, if I'm honest. And then sort of everything was going really well. And then when I was age 19, I found out, or me and my family found out, that my mum had terminal cancer. And she was given 6 weeks to live. And she ended up battling on bravely and survived for 2.5 years.
Wow.
And she really did it through, obviously amazing treatment from the NHS, but it was the zest for life that she had and a passion for us, but her friends, her family, what she was doing. And she really was just the most incredible lady. And I'm very privileged to have been brought up by her. And I feel like there's so much of her in me. And particularly poignant, I think, around International Women's Day that we've just had last week, Mother's Day yesterday. So she's been on my mind a lot, and she really does shape and drive everything that I do. But I think that her death really taught me at an early stage. I was 22. I'd gone through university, kind of having to come back a lot because she was unwell. Then she passed away at the beginning of my final year.
Oh my goodness.
And I kind of, knew then that I just wanted to get on and wanted to make her proud. And something that she said to me and my sisters when she passed away a couple of days before she passed was that she didn't have any regrets. And I remember thinking, how amazing that the only regret she had was the milestones in our lives that she was going to miss, but actually she'd lived.
Yeah.
And that kind of just changed the way I thought about things. And I think, without being too cringe, life is for living, and you don't want to wait till tomorrow because you don't know what tomorrow is going to bring. And I've kind of taken that forwards, and it's shaped who I am, really.
I think she'd be really proud of you now, though.
Thank you. I hope so. But also, I think it kind of became a bit of my superpower or a secret weapon that I had, because ultimately, when you go into the place of work, and particularly in wealth management and financial advice, predominantly people tend to think that you need to have age on your side, to have life experience on your side, to be trusted with your money. And it's a huge responsibility. People are literally giving me their savings and their pensions and asking me for advice on where to invest their money. And I don't take that responsibility lightly. But things happen to different people at different stages. And I think what happened to me taught me the fragility of life and how important it is to make sure that you're enjoying. And, it's all well and good having lots of money in the bank, but you need to have fun along the way as well. And I've taken that forwards. And I think that life experience has fast-tracked me, if I'm honest, and enabled me to have conversations that maybe I wouldn't have been able to do had this experience not happened to me. So always trying to find the silver lining, and that's my silver lining.
Yeah, I think a big topic that I discuss with lots of the women that come on this podcast is how they've turned their pain into passion.
Yeah.
And how that has become their superpower.
Yeah.
And I think that's really true when you've gone through something that's traumatic and difficult. You start to think, fuck it.
Yeah.
Like, I might as well try.
Yeah, exactly.
You know, what's the worst? Like, I've had the worst. You know, you think to yourself, I've been through the worst. What can they throw at me that's worse than I've already had?
Yeah.
So why not
give it
a go and be ballsy?
Yeah. And also, you know, my dad had a business that employed 9 people from a garage building at our home. You know, I was always around people who'd started companies, so running your own company came quite naturally. And seeing that kind of entrepreneurial spirit and how hard it is as well. You know, if it was easy, not, you know, everyone would do it. So you know, there's a lot of challenges, and it's a big risk that we both take on. And you know, that doesn't come lightly either. But I think being involved, you know, around that environment has been really key to shaping who I am. But also, I think what might come as a surprise to people, it was actually my mum in the house that ran the finances.
Really?
So the other way round, my dad actually kind of fell apart without knowing where anything was when she passed away, and literally had no clue what was going on. And it was quite interesting because he's a very successful individual, you know, worked in newspapers for a long time, runs still to this day, runs a successful PR company. But he literally has not got any interest in personal finance. And it was really interesting to see role reversal live, you know, that we've gone through, and me and my sisters just sort of couldn't really believe it. And it really was our mum that was behind all of the things that they've been doing on a personal perspective. And in a way, that was a lesson for me as well, because there's going to be a lot of people out there that are in that situation. I think that it's very stereotyped and kind of broad brush statement, and largely it is true that men control the finances. But actually, I think that there are more women than we know who are really kind of in charge of the purse strings at home.
Yeah, I think,
and it's important to recognise that.
Definitely nowadays.
Yeah,
it's much more common, and also there are a lot more women who just are, you know, in single households, or you know, they're single parents and they have to deal with it. But when I look at when my grandpa passed away, my grandma, the worst thing for my grandma, apart from losing him, was the mountain of things she had to get through, from the paperwork, the finances, the direct debits, and talking about someone who doesn't know what online banking is. And that was almost like not the most traumatic part, but it definitely led her into a really dark place, because she felt like she was drowning with it. And they were all, you know, he had shares, and she, in the end, she just sold them all because she said, I can't do this. I can't manage it, which is such a shame, because I don't know what they would have been worth now. But she just got rid of it. All because she just thought, I can't do this. And I think that it's great that now, you know, most women are equipped to handle their own finances. Because why shouldn't you be? It shouldn't be. Even if you're not working and, you know, it's the man of the house working, or you should still know how to handle everything.
Well, I think it's really interesting that, you know, a lot of people years ago thought that their main residence was their pension. They would openly say that. I know my dad falls into that camp, that, you know, worked his whole life to pay off the mortgage, now's got, you know, relatively comfortable property asset, but you can't get income from that. So suddenly you become kind of asset secure, cash poor, and then you've got all the sentimental value that goes with owning that house. You know, for us, we've got the added value. That was the last place my mum was, that was our family home, and so forth. And it's harder to sell those properties and move on from them. And ultimately that day is going to have to come, and it's actually harder for my dad than it is for the rest of us now, to make that step. And I think it's interesting because people, you know, particularly women at different stages, but I see a lot of the time women coming out of divorces and they've got the family home or they've got the property, and it's almost like that's what they wanted because they can see it, they can feel it, they can live in it, they can do things to it. But ultimately, they fall into that same situation. Is it, it may be the right decision, but not always. But, not to consider the other investments that they have, like you just alluded to with your grandma, shares, pensions, because those elements can give you an income. And, people are living longer. We want to live in the life we've been accustomed. You've got to make your money work for you, and property can form a part of that, but it's not the only way. And I think that there are more and more people talking about this now, because I think there's a lot of women that kind of come out with the family home, and, they've kept the children in the family home or whatever it may be. But in a way, it's a short-term fix, because ultimately there's got to be a level of income coming from somewhere.
Yeah, absolutely. And let's take a moment to call out inheritance tax. A horrendous thing.
Yeah.
My grandpa at one point under the Labour government, across assets and salary, was paying 98% tax, which people don't believe you when you say that. And then when my grandma passed away a couple of years ago, my mum and her brother thought, we've got a house that's worth $1 million. No.
Yeah.
They took 40%.
Yeah.
And you think you worked all your life to pay something off.
Yeah.
And a lot of the time you're really trying because you want to leave your kids something and leave your kids stability. Yeah. But at the end of the day, you're not really leaving them that much stability, because you go, and then they have to pay the bills because it takes a long time legally to be able to sell the house. So you've actually, a lot of people taking out loans, and then the government take 40% on what you already paid tax on in the first place.
And I think that, that's another thing when it comes to pensions at the moment. And I agree with you. Before I start this, I think it's a tax that should be abolished. Really, it's not fair. We pay taxes all our lives, and to have to pay tax at inheritance tax just is, on death is just dreadfully unfair, as you've just said. But, again, that comes back to the planning, because there are things that, anybody who is thinking about inheritance tax may want to consider, things like the fact that pensions currently at the moment, who knows, with all the changes that may come in, what could change, but they do fall outside of your estate for inheritance tax purposes. So when people are thinking about money that they're going to spend down, think about the things that actually are in your estate, because there might be ways that you can pass things on to other people without having inheritance tax charges. And then there's different things which we won't go into today because it's far too complicated. But, there are ways, there's planning for things. And I think that really, as with anything, the longer that you can start to consider options, it helps you to make informed decisions. You don't want to be in a situation where you think you're getting something and then you're ending up losing 40% of the value. That's a hard kind of pill to swallow. But actually, making informed decisions, that may be the best way. But if you're aware of other options, if at all there are any, then at least you know that you covered all the bases.
Yeah, absolutely. It's about planning.
Yeah, exactly.
So at what point, so obviously we know where your interest in finance came, because it came out of personal circumstances. But at what point did you then think, right, I'm going to pursue a career in this? And then how did you get your first role within finance?
So very unconventionally, I had a job at Stratton Parker that I loved. I was obsessed with property, was ready to go to Reading to do my master's in commercial property, was working all through uni at Stratton Parker. And then I met my first boss at a social occasion, and he kind of made a bit of a beeline for me, and we got chatting, and I was telling him all about where I was, what I was doing and how I was pursuing a career in property. And he was telling me about a financial planning firm that he was launching called Jerovian Wealth, which he was literally in the process of launching with his co-founder. And then he said to me, there's not enough people in the finance industry. And I really think that you should consider a career in finance. To which I laughed, coming back to my remarks around having not done maths since GCSE. And fast forward, found myself in an interview with them down in Gravesend in Kent. And I walked in, it was like 5 men round a table talking about, there was no website, there was no sort of anything. But, you know, having been off the back of kind of losing my mum, it was the summer that I just graduated Exeter. And I suddenly thought, actually, I want to have more of an impact. And that, you know, it was more of a challenge. And I thought, after speaking with them, to actually empower people with their finances, helping people to make better decisions would be better for me in my career, and something I wanted to give to try.
Yeah.
And then from starting that, I was the first employee at Jerovian.
Wow.
So there was 5 directors and me, literally learnt from the ground up, had no experience. But the best thing that happened to me was my boss, a guy called Adam Young, took me to all of his meetings. And so I worked with him for 7 years in total, but 4 or 5 years kind of on the road with him, went to all of his client meetings, really learned live. I think there's only so much that you can do from a textbook. Did all my qualifications, and started to onboard my own clients. And I saw a gap in the market. So I joined the Albright Club in Mayfair. And I literally did that the day after I qualified, because I saw them on Sky News, the 2 founders talking about this club in Mayfair. I was like, oh my goodness, I need to join. I thought it'd be a great way to meet people. And when I was there, I was staggered by the fact that professional women, even those working in finance, usually because they're time poor, weren't on top of their personal finances. So I launched an investment club, which was literally at the beginning just 10 to 15 women every month sitting round a table talking about ISAs, pensions, whatever it may be. And then I thought I can do it better than this. So I teamed up with Bonhams, and I did handbags as an asset class to be a little bit tongue in cheek. And I got 100 women.
Oh my gosh.
And they were literally queuing out the door. And I realised you need to just get people in a room, and you can talk to them for 5 minutes about anything. But if you're tired, you've had a bad day, you're probably going to cancel going to the pensions talk. I mean, I would, and I now know how important they are. But you're not going to do that with something exciting like wine or handbags or jewelry. And so that's where the idea was born. And now we get between 80 to 100 women a month.
Wow.
Coming to our events.
And that's Frankie's Club, it's called.
Frankie's Club. And in January 2023, I launched a membership, because then another thing that kind of came out of that is that kind of led to that club. I was meeting so many women. And then a lot of them were actually then introducing me to their partners. And so, you know, my wealth management side of my business is not just women, but it's a different take on what the traditional industry is doing, because I'm being introduced to the family or to the homes via the female rather than the male, which is the normal approach at the moment.
Yeah.
And basically that whole community has grown, and I started to feel that actually sometimes people don't need full financial planning advice. They just need a little bit of help and guidance. So at Frankie's, we created a membership. So the idea of the membership is that you can come to events, you can have access to our digital platform and all of our resources, and our webinar series that we have, which we do with our partners. And you get an annual financial health check, which enables you to just take stock of where you're at. I'm a very visual person, so understanding and being able to see where everything is really important. And then from that, I was kind of taking people on a journey. And at the time, I was onboarding them into Jerovian. But 4 weeks ago, literally, it's 5 weeks today, actually. So
Congrats.
5 weeks today, I got approved by the FCA. And I launched FSWM, which is my own wealth management business.
Wow.
And through I mean, completely amazingly, the 2 years of building a client base, I've got sort of 27 families that I work with, and about £13 million of assets under management.
Already?
Within the last 2 years, yeah, which is amazing. All from these clubs,
Wow.
which is incredible. And
But you've not even hit 30 yet.
not yet this year. And from that, all of them decided to come with me.
Wow.
So
That's a testament to how helpful you've been.
Which was amazing. So they've all are in the process of novating across as we speak. And yeah, just really excited about what's going on. I closed my first SEIS round.
Wow.
So I raised capital, which closed in January. So had that experience as well. So a lot of the time I'm working with entrepreneurs, professionals and families, and particularly with the entrepreneurs, I was working with people who were doing fundraising. I was making introductions to venture capital groups and angels and helping them on that journey. And I've realized now, having gone through it, until you go through it, there's only so much you can think you know. As an advisor on the outside. But it's definitely one of the toughest things, if not the toughest thing I've ever done. But have 3 brilliant angel investors on board. And I'm super excited for what we're now going to be able to build.
That's incredible. And what's it like being one of the only owners of a wealth management business that isn't a white male in their middle ages?
I think it's a huge opportunity. And I'm so excited about it. And I hope to see a lot more of me and women like me establishing businesses, because there's just such a gap in the market. So scary stat, only 16% of financial advisors in the UK are female.
Wow.
And a lot of those will work in big corporations and companies as well. So there's a huge gap. And, next year, it's anticipated that about 60% of wealth in the UK will be in the hands of women. So we've got this huge
I love that.
shift of, wealth being passed down. Women are living longer. There's a whole kind of movement that we're seeing. And then you've got this gap where a lot of those women can't relate to the financial advice industry as it currently stands. And from that, I saw a huge opportunity. Quick story for you. I remember in my first 3 weeks at Drovian, I went to a conference with one of my colleagues, and it was quite a big conference, like a kind of gala dinner type thing. And I remember looking around and thinking, oh my goodness, like literally the entire room is north of 50 white male. And initially I was quite taken aback. And then I just thought, oh my goodness, because of the way I am, this is such an opportunity, as I said earlier. But I can see why, as a young woman, you might have been very put off that industry. And, even today, I constantly get invited to dinners and lunches, and often I'm the only female in the room. So although it's getting better, we've got so much work to do. Really, there's so much change that needs to be made. And I think the other thing that's going on is there's not enough, independence. So I'm an independent financial advisor. I really believe that the word independence is so important. There's so much consolidation. So many people are sort of merging. Big organizations are constantly buying up little firms and building their wealth management businesses that way. But ultimately, you have to question whether the end client is really how that end client's being treated in that process, and are they being treated as just a number or assets under management. And that goes completely against my idea of empowering my clients beyond their finances. And I think that's a testament to how many people have decided to move across to my new firm. But I think that we need to kind of take a step back a little bit, because there's too much going on that's not necessarily got the end client in mind. And coming back to your remarks at the beginning around, you know, knowledge is power and demystifying, all of these things are not helped by the current environment that we're in.
Yeah, absolutely. And going back to what you said about the fact that you've now gone through the fundraising journey yourself, that's incredibly useful for the people that you're working with, because that's unusual. What was your fundraising experience like as a 29-year-old female trying to open a wealth management? I'm not even saying it with a straight face. Because you don't hear it. You never, ever hear it, do you? A 29-year-old female is opening up a wealth management business.
Well, I know, big steps. I think, again, if launching businesses was easy, everyone would do it. We know it's not. And in many ways, fundraising shouldn't be easy, because you need to get the right angels on board or investors on board. And, you know, you need to prove your worth. At the end of the day, this is somebody else's money. And it took about 6 months. A lot of people did kind of raise questions around my age and, you know, the fact that I was a young female, the loyalty of my clients, you know, how different I really was. And I had some really tough pitches. But actually looking back, I think those pitches have changed the way that I'm now doing business. And I'm pleased that I had those experiences. So initially, my first 2 angels came in within the first 2 weeks of me launching my fundraise. And I just remember thinking, oh my gosh, this is brilliant. Super excited. You know, what's everyone going on about? This has been great.
Yeah. And
then came the hard sort of reality that was only a quarter of the total raise. And I needed the next 75%. And then the kind of hard graft really started. And I did countless pitches. I can't even tell you how many pitches that I did, always with a warm lead. A warm in, that would be one piece of advice I would give. So I wasn't cold calling. I had introductions being made. And actually, what I had done, which I look back and was probably the best thing that I'd done before going on the fundraise, was I put an advisory board around me. An advisory board of 3 women, all with different experience in the financial services sector. And one gentleman who's been coaching me for the past few years and is also one of my angel investors. And he runs a construction business, so nothing to do with finance. But I think that he's got, you know, I just love the way he thinks and the businesses that he's grown. And having those individuals around me open doors to people and places that I wouldn't have necessarily been able to open myself. And I really think that, you know, for anyone who is about to embark on a fundraising journey, those advisors are so important, literally worth their weight in gold for being able to support you and champion you, but also help you to make those connections. And it was somebody on my advisory board that introduced me to my final angel investor, who I pitched to a couple of times. And then I've literally met him about 3 times, and he's come in as the main shareholder of the business, which is incredible. And he's got experience in the wealth management sector, and, you know, is passionate about what I'm doing. But I think another really important part of my story is that women champion me, but men backed me. So actually, it's 3 male investors that have been my angels. And I think there's lots of things that we probably don't have time to today to unpick from that, because I think that there's a big education required for female investors. I think that there's a lot of people who want to get into the angel investing or want to learn more about angel investing. But as women, maybe we need more information or a little bit more I don't like to say that women are risk averse, because in my experience they're not, but I think they need more information than men do before they make decisions. And that can hold them back from getting involved potentially in angel investing. And some people just aren't even aware that these, that the ability to invest in companies is even a thing that they can do. So I think that there's a gap there, because it was interesting. I only ever pitched to one female throughout my whole journey. So even as a business that is championing women financially, that's predominantly, my membership at Frankie's is entirely female focused. But my wealth management business is probably 60-40 women. Then, it was quite amazing that actually, I wasn't meeting other female angels.
Because there just aren't enough, are there?
I just wasn't pitching to those. And it was just one or two conversations, one major conversation, but one other conversation that I had that actually was at the audience that arguably I was championing and targeting. And it was quite interesting. But also that kind of shone a light for me on men. I think they do get, I've got a wonderful boyfriend, I've got an amazing dad, as I spoke about earlier, a brother. I think that, as much as I'm like absolutely advocate for women, I think there are some amazing men out there.
Oh, absolutely.
And I hate the term male ally, because I'm like, I don't know what sort of buzz marketing word that is. But I think it's really important that they, get a shout out, because there are so many good men out there.
Oh yeah. I think it's very easy for, some women to bash all men and put them into one category.
Yeah.
Which is just so totally not fair, because there are obviously some amazing men out there.
Yeah, exactly.
So I do think it's not fair. And I certainly never, when I started a podcast shining a light on incredible women, it was because women hadn't had that light shone on them enough.
Yeah.
It wasn't because I didn't think that there were some incredible men out there as well. And I hate this whole male bashing culture. I've been to a few events that are like very feminist.
Yes.
And the way they speak about men, I think, but that's exactly how you don't want to be spoken about as a woman. It's not going to help anybody to do it back.
It's just the same thing. And I found, you don't launch a wealth management business and shut down half the population. So, we're very much about giving financial advice for everybody.
Yeah. But
with focusing on women and championing women at the core, because I think that, I think it was just in 2022 that 73% of asset managers in the UK admitted that their products and services were tailored towards men. That's the problem with the industry. And I want to make the industry more accessible and, open it so that people don't feel disengaged, or that it's not for them, or that they're not at that point of their journey yet.
And I think it's a good point I think you brought up earlier is about the perception of wealth and how much money you truly need to have a wealth manager. Within the first 18 months of starting my business, I was told, why are you keeping your money in your business? I was like, I have enough stress. I don't know what to do. And you're making me a bit more stressed. I don't want to talk about it.
Yeah.
And they were like, but you should put it in ISAs. You should do this. You should do that. And I was like, I'm not rich. And they said, but if you've got 6 figures in a bank account just sitting there doing nothing, what are you doing? And my perception was, well, I'm not going to phone up a wealth manager. They're going to laugh at me because they only want people that have got $1 million to invest somewhere. I'm not interesting to anyone. So I, interestingly enough, never got a financial advisor, even though I now know I absolutely should have. And that would have been the smart thing to do. But I just didn't think that I was in a category where I'd be interesting to a financial advisor in a way. I thought they just wanted to sell me things and products. Yeah. And I think there's a real miseducation around the role of a financial advisor and the importance of it as well.
And I think that, you know, your perception isn't necessarily untrue, because there's a lot of financial advisors that are out there just selling products. But actually, you know, I see my role as kind of being outside of someone's circumstances looking in. So you can either help them to validate their thinking or give them a different perspective to consider. And in that, you know, for somebody that is running their own business, and it's something I come across a lot, you know, there are kind of 4 key things that I say to people that they should be considering. You know, one is actually talking about that money that you just alluded to, being sat doing nothing. Well, actually, there are strategies cash management strategies that you can use that actually enable you to earn more interest on the cash. So without you having to take any money out, you can make that money work harder for you.
Yeah.
I actually had a very strange experience when my funding came in, because even now I check the bank account every single day to check it's still there. I kind of just think, oh my gosh, this isn't my money. This is their money, and I've got a point to prove now. They've believed in me, and I've got to knock it out of the park. And so kind of, you know, people around me are like, right, you've got to get spending. I'm in the process of hiring my team and everything, but I'm quite nervous, if I'm honest, to spend the capital. Because you just don't always, you know, you don't want to make the wrong decision. You don't know where to turn. And so the first thing that I did with the money was put in a range of different cash management accounts, and then very proudly have earned, sort of over the course of distributing it into different buckets, over the next 6 months, we'll earn £11,000 worth of interest.
Oh, wow.
Which I think was quite savvy. And, you know, it's little things like that where actually, you know, you can protect the money, and you can make it work hard for you when it's in there. Something else that I always say to my clients, and also to myself now that I'm running my own business, you know, if God forbid something happened to me, now that I'm out of the bigger firm, then who would look after my clients, and who would work for a period of time when I wasn't able to work? And I think what a lot of business owners don't think about is actually the key role that you play in your business. Ultimately, you are your business. So making sure that you have the right protection in place, not just for your family, but also for you and your business, is really important. And particularly when you get investors involved, that's what they want to see. And I think, you know, another thing is that people tend to, and we're all guilty of it, you have your head down, you're in your business, you want to grow your business as much as possible. And as you say, you just associate taking money out as being counterintuitive, because you're going to have to pay tax, and ultimately all your focus is on the business. But really what you want to do is try to grow and it's easier said than done, but try to grow your personal wealth a little bit alongside your business wealth. And so things like pensions, and making sure that you are drip feeding, you know, not necessarily a large amount, but putting some money into a pension, because ultimately you're saving yourself 25% in corporation tax, and it's tax free to go into the business. You're de-risking yourself a little bit, because at least, you know, if you had been working or been employed, you would have auto-enrollment, and you would have those contributions going in. And the power of compound over time on that money is much more significant than you may think it is, and can really be a bit of a game changer.
You just think to yourself, oh, but I can't access it until I'm old, and who cares then anyway?
Exactly. Well, people do think that, but, you know, it can be complicated, but there are ways as a business owner you can actually make loans back from your pension to your business down the line. There are things that you can do which make the money more accessible for you now. But at the same time, I think don't be scared of tax. I think that tax is an inevitability. As I was sharing about what happened to my mum at the beginning, we need our health services, and we need our service, our lives to run with the various services around. So I think that, tax isn't necessarily a bad thing. It's just making sure that it's, in moderation at the right levels for you as an individual. But hoarding money, and that's what I call it within businesses, can feel like a really safe thing to do.
Yeah.
But actually, for a tiny bit more tax each year, with the right planning, you can start to build out elements of savings in your personal name, which ultimately is, just see it as diversification or de-risking.
Yeah.
And it's really important.
I'm going to fire a few questions at you.
Great.
just for any advice and tips. So let's say, for example, someone is earning £60,000 a year. How would you distribute? I mean, obviously it's different because everyone has different outgoings and expenses. But if it were you were earning £60,000, how much would you be investing in different places? For example, pension and ISAs, and because, you know, actually after tax, £60,000 isn't that much, but how would you manage it?
So I think there's no right or wrong, first of all, and it's different for everyone. And you kind of hit the nail on the head by saying everyone's expenditure, income and expenditure is different. So my first message would be to take stock and understand what you've got, where it is, what you've got coming in, what you've got going out. So then you can really start to build a picture of what you're building from and what you have. The second thing would be that, you know, anything that you're investing, I would say take a 3 to 5 year rolling view. So what you want to do is make sure that you're building enough cash around you. Now, it's subjective. Some people want to hold a lot more cash. Other people want to have less cash. Again, no right or wrong. There's different reasons for holding different things. But I think if you think that you're earning 60K, but actually you might want to purchase a property or be on a property ladder in the next 3 years, then maybe your situation is going to mean that you're going to want to hold more cash and start building money in cash savings. Other people may have a longer time horizon and therefore, you know, look to do a hybrid between cash and ISAs. So ISAs are a really great place to start. You've got a 20K allowance, albeit the government's spring budget last week alluded to an extra 5K being available for people who are investing in UK-backed equities and businesses. There's a lot more information that needs to come out about what that really entails at the moment, but it insinuates that this allowance might be increasing to 25,000, but we need to find out more. As with anything, when the government seems to make an announcement, the devil is in the detail. You know, an ISA is a really great place to start because everything within the ISA wrapper grows tax-free. You can take it out tax-free, and it's a really tax-efficient way to save. Pensions, as you alluded to, again, if you're working, then you should be contributing to a pension. And the standard is around 8%, so 3% from your employer and 5% from you as an individual. And again, when we're thinking about investing, a lot of people forget that actually if you're in a workplace pension scheme, you are already investing. It's just money that you can't see. It's coming off of your payslip, and you know, but you are investing that money. And, you know, if you've got spare capital, you might consider putting extra into that pension. You've got the ability to pay up to £60,000 a year into a pension. You're not going to go anywhere near those heights. And I think something to be mindful of is any money you do put into a pension you're not able to access until you're 57. So my message to somebody that's sort of earning £60,000 is really sort of try to think about where you want to be in the next 3 to 5 years and think about, you know, is it worth getting that tax relief on putting it into the pension, but then it's locked away? Or is it better to actually save into things that are more liquid and give you more flexibility? Personally, I lean towards that flexibility.
Yeah, absolutely. And what salary do you start to really see the nasty jump in tax?
I think that, you know, tax rates are going up, and actually the problem is that we have seen tax is actually increasing without really knowing, because since COVID we've had frozen allowances, which has created this almost like a fiscal drag, where inflation has been driving up wage growth, and we've had inflation on state pensions and so forth, but actually the allowances when you pay no tax haven't increased, so it's still at £12,570. And actually if you're earning state pensions now over 10,000, so you can see how very quickly people can be tipped into paying tax when they wouldn't have necessarily been had the allowances been increasing. The main pain point for people is when they start to earn above 100,000. because when you head above north of 100,000, you're starting to lose your personal allowance. So for every £2 over, you lose £1 of your allowance.
Oh, wow.
So, you know, and then you'll move so that you have a period of time where you kind of fall into a 60% tax bracket.
Whoa,
And
what? 60%?
yeah.
So there's basically no point earning 110k versus 100.
Well, in that example, you can do things like making a pension contribution. So if you were to be earning 110k, you might consider placing that 10k into a pension, which then draws you back down under the allowance.
Right. Okay.
So there's different elements of planning. And I think if you are in that sort of anywhere between 100 to 125, that's really when speaking to a financial advisor can be really key. Because they can help you to look at your circumstances and work out what's possible, and what planning may or may not be appropriate for you. But I also do caveat with, you know, tax is a necessary thing for the services of society. And so, you know, you can be super tax efficient, but a lot of that time, you know, it comes with certain other factors that need to be considered. So a lot of very tax efficient vehicles are very illiquid, or they mean that you have to have your money locked away for a period of time.
Yeah.
And so you have to always balance it with, okay, you want to be more tax efficient, you want your money to work more effectively for you, but ultimately, what's the end goal? Because if you go down a particular path and you're just focused on one thing, it can have consequences that you maybe weren't aware of before.
Yeah, and I think people look at, you know, like I look at Dubai and I think, oh, I don't have to pay any tax. It's so much easier. And I think when you look at amazing things this country has, like the NHS, you think, well, yeah, obviously, like I need to pay my taxes. But then there's also things where you see like the government misspend, like giving Stella McCartney 1.2 million in furlough when she absolutely never needed it. Just one example of many. But you see like the government using the money very badly is when you start to get really angry at how high taxes are. Yeah. And I think moving on to being a business owner is personally where I started to get much more confused about taxes, because I got into this cycle where I would have the corporation tax, the personal tax. There were so many different things and different invoices and different statements coming all the time and letters from HMRC and my accountants telling me that I got to a point where I thought, is this worth it? Like, I just feel like I'm paying a different tax all the time, and I've paid so much in taxes. So I think for business owners, it's probably even more difficult, because you don't get a lot of time to sit down and take stock and think, right, this is the exact tax I've paid. This is, you know, this was the personal, this was got. It's very easy to get lost in that. So from a business owner perspective, when you're dealing with entrepreneurs, founders of businesses, obviously it's quite a broad question because founders earn very varying, differing amounts. Yeah. But if you were a business owner and you say turned over, let's say £1 million, you've turned over £1 million, you've profited £500,000, and you want to pay yourself 80k a year or 100k a year, for example. What sort of steps would you take as a business owner of where you would put, I mean, it doesn't really actually matter the amounts, but the residual cash that you leave sitting in your account and thinking, I'll save it for a rainy day, or if the business goes bad, you obviously need that. But then there's a fine line there. Yeah. Where would you advise, or where do you advise your founder clients to look at putting their money to grow their wealth?
So before I answer that question, I think, you know, I completely hear what you're saying around how complicated it is. And as a founder as well, you know, there's so many things that even, you know, but working in finance, there are things that you're kind of learning. And every day, we spoke earlier about the fact, you know, every day you feel like you're learning something new. There was an analogy used on a at one of my events last week, which I thought was brilliant, that actually, you know, when we were at school, if we had a French exam, which ultimately running a business sometimes feels like we're learning another language, we would have been given time off to revise, you know, and then you sit your exam and then you would, do your test. Ultimately, we're all navigating this new world, trying to pick up the phone to people around us, your accountant, as you alluded to there, whilst running a business and learning basically a new language all at the same time. So I think we need to give ourselves some credit as founders for what we're navigating, and how difficult it can be in the beginning to kind of get on top of things. With regards to what your question, I think that, you know, if you're turning over £1 million, it's very much going to be dependent on what your spending and your expenditure is. If you're a consumer-based business that requires a lot of capital and you have to make large payments out to buy stock in to create your product, then naturally you're going to have to remain quite cash heavy, and because that money isn't going to be there for a long time. If you're more of a service-based business and actually these are retained profits, then there's more things that you might be able to do with that capital. And that's when you want to start thinking about things like making pension contributions. You know, as a business owner, you can make employer contributions from your business to a pension that moves the money out into your personal name tax-free and is saving you 25% in corporation tax. Again, as I spoke about earlier, you might consider things like the cash management facility. You know, I did one this morning for a client, and putting £500,000 across a range of different options in the cash management facility was going to earn them $25,000 over a year.
Wow.
Well, actually, and that was by maximum time locking the money away for 6 months. Well, actually, that could be sort of, you know, half, if not all, of a salary for somebody. So it's being a bit more savvy and strategic about actually making your money that you're earning work for you whilst it's waiting to be deployed. And then I guess it comes down to everything that we've discussed in terms of what's the end goal.
Yeah.
You know, do you need the business? You know, do you need to be cash strong? What sort of capital do you require? And if you can take it out, then actually let's think, you know, take a view of the business and look at ways that you can extract money tax efficiently or as tax efficiently as possible, but appreciating that there will likely be an element of higher tax to pay. But it's making sure that you're informed about that and you're doing it for the right reasons so that you can start to grow other parts of your wealth as well.
That makes sense. And a lot of the time people talked about ISAs.
Yes.
So I was definitely confused at the time. I understood what my allowance was and that I could put a certain amount tax-free into ISAs, but then I was told there were lots of different types of ISAs and, well, it's risk reward. So the bigger the risk you take, the more you can be rewarded back. Just an overview. What are sort of the main types of ISAs and the risk attached to them?
Yeah, so you've got 4 types of ISA. So if we start with the cash ISA, people tend to say that that's a really safe, secure vehicle. Obviously, it's liquid to the sense that you can access it whenever, unless you've chosen an ISA. And something to be very mindful of at the moment, you know, for the first time in 2 decades, we've started to see the ability to actually be able to earn some interest on our cash. And I think for a lot of us, we hadn't seen that before. So seeing interest rates at 4-5%, if not higher in some cases, can be really attractive. And in the short term, sounds like a brilliant thing. Something to be mindful of is that the government hasn't changed the allowances. So as a basic rate taxpayer, you can earn £1,000 of interest on cash before you start to be taxed. Higher rate taxpayer, it's £500 before you're taxed, and additional rate taxpayer, it's nothing. So it's something to be mindful of, because if people are saving a lot of money into cash, a lot of the time they're looking at those kind of headline grabbing sort of 4-5%, but actually in real terms that could be half of that. And then coming back to risk versus reward, you know, albeit it's safe and secure, at the moment inflation, albeit coming down, the target is to get down to 2%. And, you know, but we're not there yet. And ultimately, in real terms, if once you've been taxed, your interest rate is only at, say, 2 and inflation's running higher, then actually the purchasing power of that money is being eroded. So although cash is king or queen in many ways, you have to kind of think about the longer term. And I think for short term, taking advantage of the interest rates is great.
Yeah.
But you just need to be mindful of that longer term planning. Next up, you've got stocks and shares ISAs. So stocks and shares, investing in companies, and other asset classes, £20,000 allowance. Again, that is very much risk versus reward. So if you think of a scale of like a dial of 1 to 10, you get to pick the level of risk that you want to take. The higher up the spectrum you go, the more risk that you're taking. And yeah, just something to be very mindful of, that volatility moving up and down. And again, when anyone's stepping into this sort of space, I say 3 to 5 years. You want to take a rolling view, because then you don't have to worry about if it drops 10%.
Yeah.
Because you've got time to go for it to recover.
Yeah.
Then there's something called an innovative finance ISA, which is basically an ISA that is investing in peer-to-peer lending strategies. And then you've got something called a lifetime ISA. And the lifetime ISA is quite interesting because it was a government initiative brought out to either help first-time buyers by topping up what you're contributing into the ISA to assist you on getting on the property ladder, or helping people at the other end saving for retirement.
Right.
And so the maximum that you can put into a lifetime ISA is £4,000 a year.
Okay.
People need to be cautious of, though, is if you do have a lifetime ISA, you want to be aware that will then reduce the amount of money that you can pay into the other ISAs that we've just discussed. So if you're doing a 4,000 into that ISA, you can only do 16 into the others. So, the allowance is only one allowance.
Right. Okay.
So you just need to be mindful of where you're investing the money. But the two key ones I would focus on personally are those cash and stocks and shares.
Okay. See, you explained it so well there. I don't feel confused anymore. I wish I'd had that before. But yeah, it can be a bit of a minefield. And to those who I'm firing questions at you that I know are key topics at the moment for a lot of people, particularly young people. Right, you're going to buy a property for £400,000. How much do you truly need apart from the deposit? Because I think a lot of people think, right, I need to save X amount, say 10% or 20 in my case, 20% for the deposit on the property, and they don't think about anything else. Yeah. And then they get a really nasty shock when they realise stamp duty, legal fees, God knows what else. Yeah. Okay, so 400k property, you've saved up 20% for the deposit. How much else do you need?
Well, I think, first of all, kind of, you have these sort of transitions of life. So a lot of my friendship group are in the process of buying their first properties. And I remember my dad sort of eagerly waiting for me to announce that I was going to be doing the same. And I quickly said that I put all my savings into Frankie's and I wasn't going to be doing things the conventional way. So personally haven't purchased property. However, I'm around a lot of people who are doing that. In terms of what to save, I think the most common thing, as you've just alluded, is that it's much more expensive than people think. Solicitors' fees, the cost of moving, and all of the charges that go with it. It's definitely something that you need to factor in. Also, it's interesting what you said about 20% deposit that you had to put down. I think that, a lot of people think the minimum is 10%. That is required, but there's a lot of people that won't accept people at the 10%. So although that again sounds like that's the level, it can be quite difficult to look at that. And affordability of mortgages has become harder over recent years. So you're looking at sort of 4 times your income is what you can get on a mortgage. Yeah. But if you were purchasing something of 400,000, one thing that is fortunate is that you don't pay stamp duty as a first-time buyer up to the value of 425. So if you're first time buying a property at 400,000, then you're not going to have any stamp duty to pay. But you do need to be mindful of all the other things that we've alluded to. And I would suggest, having spoken to a few people, that maybe you're looking at around £10,000 that you need to have kind of put aside to cover any nasty surprises that you might get or may not have factored in.
Yeah.
And then when your property moves above 425 in value up to just shy of £1 million, it's then 5% is the stamp duty land tax that's due. Which again is something that people need to consider. And I think there was a lot of people back in COVID when there was a stamp duty land tax holiday period.
I remember that.
A lot of people were sort of dashing in and purchasing. But again, that's just one element, because as you say, there's so many other charges that are associated.
Absolutely. Okay, that's useful. And what do you think overall we can do to help empower women to take more control of their finances and feel a bit more confident? Because it's still a work in progress. We have to be realistic. Whilst lots of women are completely in control of their finances, what do you think that we can actually do to help give women that push and make it a bit less scary?
I think that, it comes back to accessibility. And a lot of people can't relate to the financial advice industry as it currently stands. And I think that you have to find somebody that you can trust and that you can ask questions to in an open forum. And I think that there's a lot of information out there, but it's not always easy to work out what that information does for you as an individual. I found it really interesting that on launching the membership model within Frankie's, which as somebody that's passionate about helping people to take care of their finances, I thought this was a really accessible way for people to start to engage with finance. Actually, what I've been finding is that people join the membership and a lot of them see that alone to be finance box ticked for the year. And they haven't actually done anything other than join the membership.
Yeah.
And I think that's quite interesting because there's so much more work that's required. So I think, keep being up to date with the information that's out there, but then thinking, how does that apply to me? And finding people like myself that you can relate to, that can help you to navigate actually what it means for you is really important. But also, and I've said this so many times, so I sound like a broken record, but see money as an enabler. It enables you to do things that you want to do. And we've got to think about, how you can make your money work for you rather than you working for money. And I think you've got to switch that relationship round. And when you start to think in that way, it becomes a lot easier to engage with finance. I do a lot of work around sustainable investing and actually having an impact. And I find a lot more of my female clients are interested in that space. But when you actually look under the bonnet of some of the sustainable portfolios, it's amazing the projects and work that they're doing, and you can really make your mark on society and have change by investing in these ways. And I think it's quite interesting that as women we tend to not just look at the bottom line return but actually care about the impact that it's having. And I think for people who are at the other end of their journey, looking at it as a legacy. If you've got a family, you want to pass your money down to your children, maybe grandchildren, whatever it may be. Actually, this is all your life's work. How do you make that money work for the next generation? And it comes down to education and making sure that people understand the value of the money that you've worked so hard to earn. Actually, when they take the baton on, how can they make it work? So that it's not just being eroded. I think there's quite a scary stat that it's like 3 generations before wealth is gone. So it passes down 3 times and then there's nothing left. And I think that that's because we're not educated enough on actually how to make the money work. Some of the tips that we've been sharing today just show you that by doing small things, you can have quite a big difference. And also, I think that, I always liken finances to going to the gym. So it's little and often. and the regularity of going that makes the real impact.
Yeah.
I think people tend to think, oh my goodness, wealth building, I'm going to get a financial advisor. I need to have loads of wealth to start. You don't. You just need to get started and it will grow over time.
Okay, I like that. And lastly, even though I could go on for absolutely hours and unpick a million topics with you, what is your big goal for your community? Because you've got your wealth management business and you've got Frankie's Club. What's the overall big end goal?
So my motto for Frankie's was the confidence to be bold. So I want to empower women within the Frankie's Club to have the confidence to be bold with the financial decisions that they're making, but also as people that actually, inspire people to step out and do amazing things. And I love what you're doing with this podcast, because you're shining a light on people that are doing amazing things in their sectors. And I think it's so important because we don't spend enough time championing others around us. But on the wealth management side, it's really just about, it's not enough. I do not believe it's enough, and sound like I'm on my soapbox, but it's not enough anymore to just service your clients twice a year and take a fee and hope that they don't notice that actually something should have changed.
Yeah.
I want to be more than just a financial advisor to my clients. I want to help them in other ways and connecting them to people and building a community that they can be part of. And that's my mission.
I love it. I can't wait to see you in the Sunday Times Rich List. Thank you so much for being here.
Thank you for having me.